Welcome back to Cavuto Coast to Coast. Deutsche Bank out with a new survey showing how much money from U.S. stimulus checks might find its way into the stock market. Half of the people between ages 25 to 34 say they'll invest 50% of their stimulus checks in the stock market. I'm back with Capitalist Pig hedge fund manager Jonathan Hoenig and Annandale Capital CEO George See. Jonathan, you would put money, would you tell someone 25 to mid-30s to put money, half of their stimulus check, into stocks at this point?
No, Dagan, and I sound a little bit like Uncle Scrooge here, but this shows again why this stimulus is really anything but. Look, we learned this. Look back in history. We learned this back with Obama and Bush back in the early 2000s. These stimulus checks are often consumed or basically frittered away. They're invested into assets. They're not invested into new production. And the money, of course, that's handed out in these checks is taken out of that private productive economy and given people too often to speculate on GameStop. So I think this is a sign of a top, the fact that so many people, when given money, just want to put it into very expensive stocks at this point. I
see doormen trading crypto on their phones. Like people just, you're getting an Uber and they're trading crypto on their Robinhood app. That's fine. Yeah. But George, let me get George in here. But I always tell people, so many people already have exposure to the stock market through a 401k plan. But I still like the idea of like you buy a few shares of stock. Maybe you don't spend half of your stimulus check, but it teaches people the ownership economy. Like you're an owner in that company when you buy even one share.
Well, I salute the young people who want to invest for the long term if that's what they're doing, but I think most of them are probably speculating. This additional stimulus is, Dagan, some of your viewers will remember rock candy when they were kids, which is pure crystallized sugar, and that's all this is a pure sugar fiscal high. And if you ever needed prima facie evidence that we've thrown too much money at the American people and this stimulus isn't stimulus anymore, it's fueling speculation and everything else, this is it. That if they're going to put their money in the stock market, they sure don't need this money. So the economy is going to glow red hot, and inflation is going to pick up, and interest rates are going to pick up, and there will be a reckoning someday, which a lot of our elders have been wagging their fingers at us for the last several months, saying there's going to be something horrible coming, but it's probably still a long way off. Anybody who's betting against the stock market this year is probably going to be disappointed because there's just too many things that are pushing it higher, at least cyclical value stocks that react strongly to economic growth.
Jonathan, Andy Kessler has a piece in the Wall Street Journal, and he said, you haven't seen a real bear market until you've lost 90% of your money. And for new investors in this environment, regardless of the asset you're buying, it's just a piece of paper. And you're trading it on, it's a hot potato with many of these asset classes.
Well, and let's not even kind of talk fantasy at 90%. Let's even talk more realistic, even more recent history, and that's 40%. The S&P, Dagan, lost 40% back in 2008. That was after the stimulus bill was passed. So this notion that stimulus is just this panacea that just can continue to keep stock prices going up and up. What oftentimes we see is that markets anticipate the news. They might anticipate that stimulus. So the jury's still really out on whether this so-called stimulus panacea really is the long-term benefit that the market needs. And as you pointed out, the Obama so-called recovery was the longest recovery in modern history. That oftentimes is the effect of all this stimulus, all this money printing on the economy.
You know what people on the left will tell you about that $800 billion stimulus back in 2009? That it just wasn't big enough. That's why the economy recovered so slowly, because it wasn't big enough. And I'll point out, so we've had, with this new one, it's $5 trillion pushed into this economy with the unemployment rate at 6.2%. Back in 2009, the unemployment rate was 2 points higher. I think it was like 8.3%. So you want to do the math in terms of how much money has flooded the system. That's a decent comparison. But again, you inflate assets and eventually they just explode in your face. Jonathan, great to see you as always, my friend. Jonathan Hoenig and George See. Still ahead, new fallout from the CDC saying that migrant facilities housing children can operate at full capacity. Not schools, but migrant facilities. We'll be right back.